Hi, Ryan. How are you?
I'm doing pretty good. How about yourself?
I'm doing okay. I did a little self trim to my bangs today, my first COVID cut. um, but yeah, so I just want to introduce Ryan because Ryan is constantly blows me away with his knowledge about financial things, financial planning. He actually used to work with the IRS. I had a situation where an employer hadn't been giving me W-2s, and Ryan really gave me some valuable advice on how to correct that for me. So I'm forever grateful for him. But he's brilliant, and I feel like with there's a lot of talk with the stimulus programs and the CARES Act of reinstating SALT. And I wanted to talk to Ryan about that and what the benefits of that would be and why it could be a good thing, especially if you were considering buying a home. So Ryan, could you kind of explain what you were telling me earlier?
Okay, so in 2017, Mr. were able to pass a new tax law, the Tax Cut and Job Act of 2018. And what that primarily did was it actually restructured how you were able to itemize on your tax return when you file your tax return for personal. So in the past, every individual was able to deduct all of their property taxes, all of their state taxes, and any local taxes that they paid during the year. And there was no cap, and it was advantageous to people who own homes who were paying a lot more than just their local and state taxes, but also paying high property tax values in the different states that they're in. So because of the itemization rule in the past, this benefit allowed people to get refunds on taxes they had paid during the year. So when they were doing the tax cut, they decided they were going to cut back on giving people refund and try to, and essentially decrease the amount of people who were able to qualify for itemization. So one of the things that they did was they capped the taxes that you were able to deduct in the past, and they call it SALT. SALT stands for local and state local. I'm sorry, state and local property taxes. So primarily what that means is that if you live in a state and state taxes and you pay property taxes, you can deduct up to the cap of $10,000 if you're married filing jointly, or $5,000 if you are single. Prior to 2018, there were no such caps. So if you whatever you paid to your state and your local, and city taxes, you were able to deduct that in addition to your property taxes. So what that would have done is it put you into what's called itemization, and you'd be able to get a refund on taxes you were paid during the year. The SALT tax became very unfavorable. So when it was put into place, a lot of homeowners started to lose benefits they had in the previous years because they weren't able to itemize anymore, because they got rid of all of the they call it EBE, which is the employee business expenses that you were able to do that worked for a specialty department, such as the fire department, the police department. They restructured the itemization to the point where it's essentially impossible to itemize because the standard deduction is so high. So the standard deduction for every individual is $12,200, and it doubles. And if you're a head of household, it's $18,000. So SALT made it very, very hard for people who buy homes to benefit from deducting property taxes, because the cap is so low that, for the most part, if you own a home and you're in New York, for example, you're paying New York State and New York City taxes. If you're a high income earner, you're paying way more than $5,000 just on state and local taxes. That means at the end of the year, when you try to file your return, you'd only be capped at $5,000 if you're single. So in that instance, you would only be taking a portion of your state and local taxes and no property taxes. You could only deduct the mortgage on your Schedule A. So that's what makes it difficult for people to apply and get the benefit of the SALT tax, which they had in the previous past.
But Ryan, you did point out, even if we don't get this reversed, which I think, relative to other property taxes across the country, like, where does New York rate?
New York ranks in the medium level. They're not as low as like some other states in the suburbs, and they're not as high like as California and New Jersey. They're right in the middle. But the issue is that not only the property taxes are affordable, is that if you really do the calculation and you only own a home, the benefit that you're losing from the SALT tax is really is not material, because you're losing between $1,000 or $2,000 of refunded credit you would have gotten if you were able to deduct the entire amount. Under the new SALT law of the cap, you can't deduct the entire amount. But nonetheless, for most people, if you do the calculations, you would see that you wouldn't have gotten a bigger refund anyway, because it's not only the SALT tax that was impacted on the Schedule A, it was the employee business expenses, property taxes, medical expenses, and mortgage. So everything has changed because they no longer want you to be able to itemize. So now you could only really deduct your medical expenses, which is a higher deductible amount, plus property taxes capped at 5 or 10,000, mortgage interest capped at $1 million for homes. Then there's an unlimited cap for charitable contributions, but that's a catch-22. You have to actually either give donations with cash to get it right back. That makes no sense to just give to an organization just to write it off. Essentially, you're not getting the same value of the $10,000 when you file your return. So it's a very difficult time, because the SALT tax, which is one of the biggest things on the Schedule A, was actually restructured. If they do lift the ban and they put it back into place, New Yorkers will be able to apply and get the full benefit for their state, local, and property taxes. But nonetheless, they still will not get a big refund because they cannot deduct employee business expenses, which most people were doing it in the past. And that was the biggest portion of Schedule A that caused the issues that made them restructure the form.
Interesting. So maybe people should be really pushing to be getting that back too.
That would never come back,
sounds like,
because it was really unfair, because essentially speaking, you and I both work, and you're a real estate agent. You have to dress nice for your clients. In the past, you were able to deduct that as employee business expenses. Now, legally speaking, your job requires you to look a certain way so that you can sell to your clientele. Now you have people who are like, I'm a police officer, firefighter. My uniform fees are $8,000. People abuse it so much to the point where they had to replace it. And because when they replaced it, that was the only thing that they said they were never reinstate again, because it's unfair for the average person who works on Wall Street, who buys a suit every single day and don't deduct it, but a firefighter or a police officer can deduct it. So that part is probably never going to come back at all.
A quick question, because as a real estate broker, I'm an independent contractor. So would I still be able to deduct? Okay.
Absolutely. As an independent contractor, where you have a Schedule C or LLC, and you file Schedule C, you're able to deduct all that expenses on your business return. But if you were an individual working with your Social Security number, you would not be able to deduct it, because it would have been in the form of a W-2 wages, and you would not be able to qualify for the employee business expenses, because it no longer exists on the personal level. Only on the business levels it exists.
I see. But you also did mention the SALT really only affects your primary residence. So if you
Correct.
owned another property, possibly like a rental or investment property, what are the tax benefits of owning one of those?
So owning a rental property has the most tax benefits, because primarily speaking, you have now sheltered your leverage business. Your business is no longer part of you, it's its own entity. So when that happens, you can deduct as much property tax as you pay and as much mortgage as you have. So if you happen to buy a $3 million home and your mortgage is $10,000 a month, you can deduct the entire amount because you're using for rental property. If the property taxes was $8,000, deduct the entire amount, because on the business level, there's no cap because it's an expense to the business. On the personal side, there is a cap because it's not an expense to the business, but it's an expense to you, the individual, who the government is saying, hey, you don't qualify for this expense anymore because we can't afford to give you a refund back just for doing what you should have been doing to take care of your own personal home.
I see. Thank you so much, Ryan. I'd like to invite you, if you're available next Saturday at 2, to really discuss the other financial benefits of owning your own home. We kind of briefly talked about it, but really just building equity in yourself. Are you available next Saturday at 2?
Next Saturday at 2, I'm not available. I'm available at 1.
Oh, okay. So next week we'll be meeting at 1. I hope that everybody that's on this call can join. And please, tell your friends. And then Ryan, could you just explain a little bit about what Xpert Financial Care, some of the services that you offer? Because you don't only offer tax preparing, you do a lot. And
yeah,
yeah.
so expert financial care is a one-stop shop. I always tell people I'm not the average tax preparer. I want people to really benefit from financial literacy. So what I do with every client that I meet, whether it's through tax or through financial planning, I try to encourage them to get on an action plan to achieve their financial goals. And what that entails is it entails a lot of just really being real with yourself, doing a budget, and planning for your financial future. So expert tax prep does a lot of things for individuals, such as tax preparation, budgeting, forecasting, retirement planning, and tax shelter slash tax planning preparation. So I help individuals understand their tax liability, how to cut it, how to increase it by doing different things that are legal tax shelters, such as like investing in a 401k, investing in a Roth IRA or IRA, using defer accounts to defer money so you don't pay taxes in the current year, and so forth. And then on the business services, such as bookkeeping, financial literacy. Most of my clients, I'm their accountability partner. I check in with them every month to make sure that they're following and they're meeting their expected goals in terms of growing their businesses and scaling their. I help people understand cost structure so they can make the best profit margins for their businesses. A lot of people do not price their items good properly when they're selling it because they're not conscious of all that it takes to actually create the actual product. So I teach cost accounting in that aspect so people can understand that, hey, if you own a product, you have to consider the bag that you're using, the packaging, the materials, the ink used to print the label, the light in your house you're using to use when you're working, your rent for your home. All that is added back into the price because of the price to sell the product. So we do that. We do tax planning for businesses. We do financial workshops where I teach literacy and how to understand your business, but most importantly, how to grow your business. Everyone went into business to make money, and my goal is to help them achieve those goals by getting financially organized. Because the biggest issue with individuals and small businesses that make them fail or not succeed at their goals, they're not financially organized. So they don't know how much money they're actually making, how much they're spending. So they go through a rat race year after year, trying to figure out, hey, I know I made $100,000 last year, but how come I didn't save $5? And then it's like to really look at, oh, you're overspending, or you didn't make $100,000. You use $40,000 of credit card debt to substitute your expenses in your business. So speaking, you made less money. So it's really about getting people to understand that there's a bigger picture to financial literacy. And once you do that and you understand the benefits, it's smooth sailing from there. We're gonna achieve goals. We're gonna make money, and that's all I can.
Yeah, I have to say one of the things. Well, there's a couple things I want to mention. One, Ryan and I did a talk about a couple of years ago, and one of the things they mentioned when we were having the talk is Ryan is an entrepreneur from way back in like preschool or kindergarten or something. He was selling lemons from trees outside, taking them to school. So he's been doing business since before he even thought about doing business. He's amazing. And I do talk to people a lot about making sure you're actually going to pay yourself, and it's not an easy thing to do for yourself. So I think that if you do need to, you definitely need to talk to someone like Ryan. And then I want to mention that if you are considering an investment property at this time, it's a great time. There are still deals happening. There's transactions happening. Transactions happened in March and in April. And we've been in a buyer's market for quite a while. So if you're interested in looking for an investment property in New York, please contact me, and I will see you guys. I'll see you next week at Saturday at 1.
At 1. I see you guys.
Okay.
Have a good one. Just
Thank you.
before I go, I'm gonna have a live on Tuesday at 8 p.m. I'm sorry, at 7 p.m. 7 p.m. Eastern time. And this week I'm discussing how to survive as a small business owner and entrepreneur, with topics which will include how to pay yourself properly, how to save for retirement since you're self-employed, how to financially plan so that you have money to sustain yourself and the business over a 6-month period at any given time so you can be successful in your businesses. So that's the topic of next